I was talking to a young engineer a few years back, sharp fella, probably made $70,000 a year at the time. He asked me where he should put his first investment dollars, and I asked him if his company offered a retirement plan with a match. He said yes, they matched 50% up to 6% of his salary. Then I asked him how much he was contributing. He said zero. He wanted to learn about stock picking first, get good at it, build up some capital in a regular brokerage account where he had control. I told him he was making about the most expensive mistake a young person can make. The account I'm talking about is your employer-sponsored retirement plan, the 401k or 403b or whatever version your workplace offers. More specifically, I'm talking about contributing at least enough to capture every dollar of employer match, not some of it, all of it. This isn't complicated advice, and that's probably why people ignore it. They're looking for something clever, some edge, some secret. But the secret is that there's no secret. The math is sitting right there in front of you, and most people walk past it. Let me show you what I mean with actual numbers. Say you're 30 years old, making $50,000 annually. Your employer matches 50 cents for every dollar you contribute, up to 6% of your salary. You put in $3,000 a year, they add $1,500. That's $4,500 total going into the account annually. Now assume you get small raises over time, maybe 3% a year, and your account grows at 8% annually, which is reasonable for a stock-heavy allocation over multiple decades. By age 65, you're looking at roughly $1.1 million. Your actual contributions over those 35 years total, maybe $160,000. The employer match adds another $80,000. Everything else, about $870,000, is compound growth. You didn't need to outsmart the market. You didn't need inside information. You just needed to show up and take what was offered. Now let's say you wait until you're 40 to start. Same match, same contribution rate, same returns. You end up with around $480,000 at 65. You've lost more than $600,000 by waiting 10 years, not because you contributed dramatically less, but because you gave up a decade of compounding. That's the cost of waiting. That's the cost of thinking you'll get serious about this later. The interesting thing about that 10-year delay is how it compounds in ways people don't expect. It's not just the contributions you missed, it's the growth on those contributions. It's the growth on the growth. Every year you wait, you're not just losing that year's potential savings, you're losing 30 or 40 years of what that money could have become. A $3,000 contribution at age 30, growing at 8%, becomes about $45,000 by age 65. That same $3,000 contributed at age 40 becomes only about $20,000. You've lost $25,000 of future wealth by waiting on a single year's contribution. Multiply that across 10 years and you see where that $600,000 gap comes from. People tell me they can't afford it. They've got rent, student loans, a car payment. The money feels tight. But here's what I'd ask you to think about. If your employer announced tomorrow that they were cutting your pay by 4%, you'd adjust. You'd find a way. You'd cut back somewhere. This is the same thing, except the money isn't disappearing. It's going into an account with your name on it, and your employer is adding to it. The question isn't whether you can afford to contribute. The question is whether you can afford not to. I'll give you another way to think about it. That employer match is the closest thing to free money you'll ever see in your financial life. If your employer matches 50%, that's an immediate 50% return on your contribution. Where else can you get that? The stock market averages maybe 8 to 10% over long periods. Bonds give you less. Real estate has costs and risks. But the employer match gives you 50% or sometimes even 100% the day you contribute. It's guaranteed. You don't have to hope the market goes up. You don't have to wait for a property to appreciate. You just get it. There's a tax piece here that makes this even more powerful. Most of these plans are tax deferred. You contribute before the money is taxed, which lowers your taxable income. If you're in the 22% bracket and you put in $5,000, you just saved $1,100 in taxes that year. The money grows without being taxed along the way. You pay taxes when you withdraw it in retirement, presumably when your income is lower and your tax rate is lower. Some plans offer a Roth option where you pay taxes now, but the growth is tax-free forever. Which one makes sense? Depends on your current tax rate, your expected future tax rate, your age, a bunch of factors. I can't tell you which is right because I don't know your situation. But either way, the tax advantage is real. The traditional approach makes sense if you think your tax rate will be lower in retirement than it is now. For most people starting their careers, that's probably not the case. You're likely in a lower tax bracket now than you will be in your peak earning years. So the Roth option, paying taxes now on money that's taxed at a lower rate, might make more sense. But this gets complicated quickly. If you're in a high tax bracket now and you expect to live modestly in retirement, the traditional route could save you more. There's no single right answer. The important thing is to contribute enough to get the match, regardless of which tax treatment you choose. I hear from younger folks who say they'd rather keep the money in a regular brokerage account where they can access it any time. They don't want it locked up until they're old. I understand that instinct. Flexibility sounds valuable, but here's the trade-off. In a taxable account, you're paying taxes on dividends and capital gains every year. That's friction eating away at your returns. And when money is easy to access, people tend to access it. There's always something, a vacation, a new car, something breaks, the money leaks out, the retirement account creates a barrier. You can get to the money if you truly need it, but the barrier makes you pause. It protects you from yourself. Let me tell you about a couple I knew in Omaha. Both of them worked. Both had access to retirement plans with matches. The husband contributed enough to get his full match from day one. The wife decided she wanted more flexibility, so she took the extra money and put it in a savings account she could access anytime. Over 20 years, that savings account got rated repeatedly. Down payment for a bigger house, new cars, a boat they used twice, emergency expenses that might not have been true emergencies. Meanwhile, the husband's retirement account just kept growing. When they hit their mid-50s and started thinking seriously about retirement, his account had about $400,000. Her savings account had maybe $20,000. Same household income, same expenses, but one of them had protected their future self by making it just slightly harder to access the money. The best investment plan is one you'll actually follow for 30 or 40 years. These employer plans make that easy. The contribution comes out before you see the money. You don't have to remember to invest each month. You don't have to resist the temptation to spend it. It happens automatically. That might sound trivial, but it's not. Most people fail at investing, not because they pick the wrong stocks, but because they don't invest at all, or they stop when things get hard, or they panic and sell at the worst possible time. Automation removes those failure points. Now, I'm not saying this account is the only thing you should ever do with money. If you've got credit card debt at 18% interest, pay that off first. The math doesn't work if you're earning 8% on investments while paying 18% on debt, and you need an emergency fund, 3 to 6 months of expenses in something liquid and safe. Life throws curveballs. If you have no cushion and something breaks or someone gets sick, you end up raiding the retirement account, paying penalties and taxes, setting yourself back years. But once you've handled high interest debt and built a basic emergency fund, capturing the full employer match should be your next priority, not individual stocks, not saving for a house down payment in most cases, not cryptocurrency or whatever the current excitement is. The employer match is a guaranteed return that you won't find anywhere else. Let me walk through a realistic scenario for someone just starting out. You're 25, making $45,000. You've got $10,000 in student loans at 5% interest. You've got $2,000 in credit card debt at 19%. You've got nothing in savings. What do you do first? You attack that credit card debt. 19% is eating you alive. You get that to zero as fast as possible. Then you build a small emergency fund, maybe $2,000, just enough to handle a car repair or a medical bill without going back into credit card debt. Then, even while you're still paying off the student loans at 5%, you start contributing enough to your retirement plan to get the full employer match. Why? Because the match gives you a 50 or 100% return, and the tax benefit adds another chunk, and compound growth over 40 years will turn that money into serious wealth. The student loans at 5% can wait a bit. They're not pleasant, but they're not an emergency compared to the opportunity cost of missing out on decades of compound growth and free employer money. I knew a nurse who worked at the same hospital for 30 years. She wasn't making a fortune. She contributed just enough to get the full match, maybe 6% of her salary, and she never thought much about it. Didn't check the account often, didn't try to time the market, just let it sit in a basic target date fund. When she retired, she had just under $500,000 in there, combined with her pension and Social Security. She was comfortable. Not rich, but secure. She didn't have to worry about every expense or depend on her kids. That's the power of consistency and time. Some plans have vesting schedules. The employer contributions might not be fully yours until you've been there 3 to 5 years. If you leave early, you might forfeit some of the match. Does that change the equation? Not much. Your own contributions are always yours. The growth on those contributions is always yours. Even if you lose some unvested match by leaving, you're still better off than if you'd never contributed. And you might stay longer than you think. Better to assume you'll be there long enough and be wrong than to assume you'll leave soon and give up free money. The other thing people worry about is market crashes. I remember 2008, accounts were cut in half. It was painful. Some people panicked and sold. Some stopped contributing. Both reactions are natural and both are wrong. If you're 20 or 30 or even 40 years from retirement, market drops are opportunities. You're buying shares at sale prices. When the market recovers, and it always has, those cheap shares are worth a lot more. And the people who kept contributing through the crash ended up way ahead. Here's a specific example. Say you were contributing $500 a month to your retirement account in 2007. The market was high. You were buying shares of your index fund at, let's say, $50 per share. So you were getting 10 shares per month. Then 2008 hits, the market crashes. Those same shares are now trading at $25. Some people stopped contributing, afraid to throw good money after bad. But if you kept contributing that same $500 per month, you are now buying 20 shares per month instead of 10. By 2010, the market had recovered and those shares were back to $50. The shares you bought in 2008 and 2009 doubled. The people who stopped contributing missed that opportunity entirely. This is where temperament beats intelligence. You don't need to be smart to succeed with a retirement account. You need to be steady. You need to keep doing the same boring thing year after year, regardless of headlines or what your brother-in-law is bragging about. That's harder than it sounds. Humans want to do something. We want to be clever, but boring wins in investing. The excitement usually costs you money. There's something else these accounts give you that nobody talks about. Freedom. Not the freedom to retire at 40 necessarily, but the freedom to make choices. If you're in your 40s with $200,000 in a retirement account, you can take a job that pays less but is more interesting. You can leave a bad situation. You have options. The person with nothing saved is stuck. They have to take whatever comes and put up with whatever happens because they can't afford to do anything else. I think about this in terms of what Charlie used to call optionality. Money in a retirement account is future optionality. It's the ability to say no to things you don't want to do. It's the ability to take a year off if you need to care for a parent. It's the ability to retire at 62 instead of working until 70. Every dollar you save today is buying you a little bit of freedom tomorrow. And the employer match means you're buying that freedom at a 50% discount. Let me be clear about something. The investment options inside these retirement plans aren't always great. Some companies offer plans with high fees or limited choices. That's frustrating. But even a mediocre plan with an employer match is better than no plan at all. The match is so valuable that it overcomes a lot of other problems. If your plan charges 1% in fees when you could get a similar investment elsewhere for 0.1%, that's annoying. But the 50 or 100% match on your contributions still puts you way ahead. That said, if your plan truly has terrible options, like really high cost actively managed funds with expense ratios above 1.5%, contribute enough to get the match and then consider putting additional savings elsewhere. But get that match first. Always get the match first. Let me tell you what happens to people who don't do this. I've seen it over and over. They get to 50 or 55 and suddenly realize retirement is 15 years away and they have almost nothing saved. The panic sets in. They start contributing as much as they can, but they've lost decades of compounding. They're trying to make up for 30 years of missed contributions in 15 years. It's possible, but it's painful. It requires massive contributions, much bigger than what they would have needed if they'd started early. And they're doing this at a time when they might have kids in college or aging parents who need help or their own health problems starting to emerge. The stress is enormous, all because they didn't take the free money their employer offered when they were young. Nothing is guaranteed. Markets fluctuate. Companies change their policies. Life happens. Medical bills, family obligations, things that force you to stop contributing or even withdraw early. What I'm describing is a strategy that's worked for millions of people over many decades, but that doesn't mean it works perfectly for everyone. You need to think about your specific situation and talk to people who know your finances better than I do. But if you're working somewhere that offers a match and you're not getting it, you're leaving money on the table. It's not a subtle mistake or a complicated one. It's just a mistake. Fixing it doesn't require genius or luck. It requires deciding to do it and following through. I've spent my career looking for good investments, businesses selling for less than they're worth, situations where the odds are in my favor. The employer matched retirement account isn't the kind of thing I usually discuss. It's not about finding an undervalued company or understanding a competitive moat, but in terms of return for effort, it might be the best financial decision most people can make. You contribute, you take the match, you let time work. Decades later, you have security and options. The young engineer I mentioned at the beginning, he eventually came around. Took him about a year, but he started contributing. Last I heard, he'd been at it for over a decade. His account had grown to something in the low six figures. He told me it was the best financial decision he'd ever made, better than any stock he'd picked, better than any clever strategy he'd tried. Just showing up, taking the match, letting it grow. That's really what this comes down to. Investing doesn't have to be complicated. For most people, it shouldn't be. The employer matched retirement account is simple, effective, and available. It's not glamorous. You won't have stories to tell at parties, but 30 years from now, you'll have security. You'll have options. You'll have freedom. And that's worth more than any story